If you spent years working overseas, kept a rental or a pension, then moved back to Australia, this is for you. You probably believe you've already paid your tax abroad, but the Australian Tax Office sees it very differently, and that gap can cost you dearly. Tens of thousands of returning Australians quietly overpay because nobody warned them. There are 3 moves to stop the leak. Confirm your residency and list every foreign income source, map the cost base of your overseas assets, and claim every foreign tax credit you're owed. Here's the number that catches everyone out. 100% of your worldwide income is taxable in Australia once you're a resident. PwC Tax Summaries 2024. That means salary, rent, dividends, capital gains, and many foreign pensions, not just your Aussie wages. And here's the part nobody tells you. The foreign tax you already paid rarely covers it all. 3 moves, and we'll walk through each one. Confirm your residency and income, map your cost bases, and claim every offset. Each takes under 30 minutes and costs nothing. Once the ATO treats you as an Australian tax resident, you're taxed on everything, everywhere. Overseas wages, foreign pensions, rental income, dividends and capital gains on investments you built while abroad. PwC Tax Summaries 2024. Non-residents only pay tax on Australian source income. So the moment you settle back home, the rules flip completely, and most people never realise it changed. Take a UK flat earning AUD 30,000 in rent. You pay UK landlord tax at 20%, about AUD $6,000, but your Australian rate on that rent is 32%, or AUD 9,600, Atlas Wealth 2024. Australia gives you a credit for the UK tax, but you still owe the difference, roughly AUD 3,600 every single year on income you thought was already settled. The second trap is timing. When you move back, there's a deemed acquisition of your foreign investments at their market value on the day you become a resident. That value becomes your new Australian cost base, Atlas Wealth 2024. Any gain from that point on is taxable here, and bizarrely, even converting your foreign cash to Australian dollars can trigger capital gains tax because the ATO treats the currency itself like an investment. So picture an ETF portfolio worth AUD 150,000 the day you land, sold 3 years later for AUD 210,000 to fund a house. That AUD 60,000 gain after the 50% discount adds AUD 30,000 to your income and costs, about AUD 9,600 in tax. PwC Tax Summaries 2024. The foreign country may tax a different figure with no cost-based reset, so your credits don't line up and you're out of pocket. The myth that traps almost everyone is this: I paid tax there, so Australia can't tax it again. PwC Tax Summaries 2024. The fact is, residents must declare all foreign income to the ATO. Treaties stop double taxation, but they don't cancel your Australian tax. They only give a credit up to what you'd owe here. Add it up over a working life back home and it's brutal. Keeping a foreign rental for 20 years costs around AUD 72,000 in top-up tax. And just 2 mistimed asset sales add about AUD 90,200 more. Atlas Wealth 2024. That's roughly AUD 91,200 in avoidable tax, money that should have stayed in your retirement. Meet Sarah. She's 39, a product manager at a Sydney tech firm on AUD 160,000. She spent 10 years in London and moved home 2 years ago, keeping a UK flat, an ETF portfolio now worth AUD $210,000, and some cash in a British bank. She thinks she's fully compliant. Here's what Sarah found. First discovery, AUD 3,600 a year. Sarah pays 20% UK tax on her AUD 30,000 rental profit and assumes she's done. But as a resident, she must include that rent in her Australian return at 32%. Atlas Wealth 2024. She gets credit for the UK tax, but still owes AUD 3,600 more each year. AUD $36,000 over a decade she never budgeted for. Second discovery, AUD 9,600. Her ETFs were worth AUD 150,000 when she returned, which became her Australian cost base, and they're now worth AUD 210,000. Atlas Wealth 2024. That AUD 60,000 gain after the 50% discount lands her a AUD 9,600 tax bill the moment she sells to boost her home deposit. PwC Tax Summaries 2024. Third discovery is the one that stuns her. AUD 3200 from currency alone. Her GBP 40,000 was worth AUD 80,000 when she landed. 2 years on, the Australian dollar fell and it's worth AUD $100,000. Atlas Wealth 2024. That AUD 20,000 exchange rate gain is a taxable capital gain, AUD 3,200 in tax, just for moving her own savings home. Stack Sarah's three discoveries together and she's looking at AUD 48,800 drained over a decade, before any interest or penalties for late declaration. None of it came from earning more or taking risk. It's purely the international tax rules quietly working against someone who didn't plan for them. So could this be you? You kept an overseas rental, pension or brokerage account after moving home. You don't actually know what your assets were worth the day you became a resident. And you've never declared that foreign income because you figured it was taxed over there. If any of those ring true, the next three moves are for you. 3 moves. Let's do them. And every tool here is free and online. Start with the first move today. It only takes a few minutes, and the rest follow from there. Move 1. Confirm whether the ATO considers you a resident, then list every source of foreign income you have. Use the ATO's "Am I a resident for tax purposes?" tool for the answer. Then build one consolidated list from your overseas bank statements, payslips, rental records, and broker reports. This is general information, not personal advice, but knowing your status is the foundation for everything else. Log into MyGov and link the ATO online service. Open your last lodged return and check whether your foreign salary, rent, interest, and dividends are sitting in the foreign income labels. Cross-check against your overseas records. Good looks like one single list of every foreign income source. Move 2. Work out the deemed acquisition date and Australian cost base for each overseas asset. Find what each one was worth in Australian dollars the day you became a resident again, because that figure is what every future gain is measured from. Use your broker and bank portals to export transaction histories and valuations at that exact date. First, pin down the date you became an Australian resident using the ATO tests, then export portfolio valuations and exchange rates as at that day, and record each value in Australian dollars as your cost base. Good looks like being able to say, for every asset, if I sold today, my taxable gain is about this much. Move 3. Make sure you're claiming your foreign tax credits properly so you're not taxed twice. Gather every foreign tax certificate, then use the ATO's Foreign Income Tax Offset section to enter the exact tax already paid on each income type and check the relevant treaty for who has the primary taxing right. Collect your foreign tax summaries, dividend withholding notices, and any US 1099 forms. Enter the exact foreign tax paid in the offset section of your return, then cross-check the Australia-UK or Australia-US treaty for relief on things like pensions. Good looks like no unused offsets left on the table. And why does this matter right now? Since 2023, the ATO has shared financial data with over 100 countries, so foreign accounts are increasingly visible. In 2024, it flagged foreign rent and capital gains as a compliance priority. And through 2025, returning expats are under closer review, ATO. The window to fix this quietly before the ATO comes asking is closing. Once you've acted, verify it. You should see all your foreign income appearing in the correct labels of your tax return. Confirm each foreign asset has a recorded Australian cost base and date. And if you paid foreign tax, a matching offset should show up in your assessment. Everything here is drawn from PwC's Australian Tax Summaries, Atlas Wealth's Repatriation Guidance, the ATO, and the official Australia Tax Treaty documents. All the links are below so you can check the detail for your own situation. Today, you learned why Australian residents are taxed on worldwide income and the 3 moves to stop overpaying. Next, we tackle whether returning expats should sell foreign assets before they even move home. If this saved you from a nasty ATO surprise, subscribe. We read the fine print so you don't have to. And there's a new one every week.